we're going to turn it over now to Lauren and Jennifer and get started. Lauren, you should have control.
Great. Thank you, Amy. Hello, everyone. Thanks for joining us on this lovely Friday. It's always a good Friday when you're talking California sales and income tax. My name is Lauren Taylor. I'm a tax senior manager here in our state and local tax group. I currently reside in the Denver, Colorado, Boulder, Colorado area for our firm, and Jennifer Barajas is a manager in our state and local tax group. She will also be presenting today. She works remote from Texas, but is out of our Phoenix, Arizona office. So for today, we have a few topics we'd like to touch on. I'm just going to go through these for you quickly. So we're going to talk about opening and closing a business in California. So we'll identify some important state agencies. We'll go through some forms and fees for registering, as well as steps to close a business. We'll talk through doing business in California. What is the definition of doing business? We'll talk through factor presence, nexus, and just some other business related activities. Then Jennifer is going to take it over and talk through apportionment and sourcing. She'll walk through business income versus non-business income, talk through market-based sourcing, as well as destination and origination-based sourcing, which is both income and sales tax related. And then she'll talk through pass-through entity reporting, so forms to file by entity type, withholding on California source income, and she'll speak to the Swart and Jolly California cases and tax implications. All right, so opening and closing a business. On this slide, I've listed out some common California state agencies that you should be aware of. We'll just go through these. So you have the California Secretary of State, or the SOS. This is where you do all your registrations, and registrations required for C Corps, Corps, LLCs, LPs, LLPs, and even nonprofits. This is where an entity is going to file the organization and incorporation papers. Filing with the SOS also gives the company their legal standing in California. And in the next few slides, we'll talk about when to register, but let's get through these other agencies. You've got the Franchise Tax Board, which handles pretty much all income tax types, so franchise, corporate, and personal income tax types. Then, depending on how familiar you are with California, they used to have, well, and still do, but the State Board of Equalization used to handle a lot of tax types and issues. And about 3 years ago, they restructured it and broke it into 3 separate entities. So we still have the State Board of Equalization, but they just handle property tax, the alcoholic beverage tax, and tax on insurers. And then you have the Office of Appeals, which is, as it says, they handle appeals and protests, as well as other legal matters for taxpayers. And then we have the CDTFA, which stands for California Department of Tax and Fee Administration. They pretty much handle every other tax and fee program that the Board of Equalization does not. So they handle sales and use tax. That's the big one. And then other tax and fee programs, I listed just a couple as an example, are the cannabis tax, diesel fuel tax, and California tire fee. There's about 70 or more of those, so there's quite a comprehensive list. Then we have the Employment Development Department. This is the department you're going to go through if you have employees and payroll taxes in the state, or issues with payroll taxes and employees. And then lastly, which probably isn't something that's very common, but wanted you to be aware of it, is the Governor's Office of Business and Economic Development. This is an office that basically offers contact information for permitting authorities. So they issue information at a state, local, regional, and even federal level. So very specific industry, probably targeted, but just, again, just wanted you to be aware of that agency. Okay, so as I mentioned, when do I register? This is, we're going to kind of take a focus So this portion is, when do I register with the Secretary of State? If you're organized or incorporated in California, you should be registered with the Secretary of State. If you're a foreign entity, some present, things that would create a reason to register would be a physical presence in California. So anytime you have people, property, inventory, anything of that nature that would create a physical presence would require you to register. If you have repeated business transactions or significant activity, California loves to push on this. They never define significant, which is always super helpful. But essentially, if you're making repeated, transactions, you're targeting a market in California, you're targeting California customers, that's a pretty good indication that you should register. The last one I have on here is you've exceeded economic presence thresholds for income, sales, or maybe even both. You would probably want to register as well. We will go over what those thresholds are in the upcoming slides, but just wanted to plant that seed. Another question we get is not just when should I register with the Secretary of State, but from a sales tax perspective is when should I register with the CDTFA for sales tax. And sales tax is going to kind of have a couple similar to the Secretary of State in that, again, physical presence, that creates nexus, that creates a filing, remitting requirement. So, people, property. Another one that I think a lot of companies sometimes overlook or just don't think about is, as we move to where we use third party like an Amazon to sell our products. If you have inventory in an Amazon fulfillment center in California, that is physical presence, and therefore you should be registering for sales tax. Another one that's somewhat kind of relevant, maybe not in 2020 and going forward, but trade show presence. This may or may not create nexus. California's rules are if you're there less than 15 days, you sell less than 100,000 in sales, you don't create nexus, but they still want you to obtain a temporary license and collect and remit sales tax. Then, one thing I just kind of wanted to point out too is we see this a lot where a company decides they want to do business in California. They get gung-ho and they register with the Secretary of State or they register for a seller's permit. And then turns out the project gets delayed or something happens where they may not go in for another 6 months or another year. Well, just a point to note is that once you register with California, they expect a filing, whether it be an income tax filing or sales tax filing, whether you're filing zero, they are pretty aggressive on that, and they will definitely send a notice, and they want tax and penalties and interest. So just keep that in mind as if you're considering doing business in California and you're being proactive and you're registering, that even if you don't have activity for a while, you need to make sure that you're filing all the required forms. Okay, so this slide and the next slide, I've just kind of broken down some of the more common forms that you would file with the Secretary of State by entity. This table is for a domestic entity. As you can see, every type of entity or business structure has a different form that needs to be filed. Some of them are pretty similar in price. Corp's $100, that's the most, and then nonprofits get a little bit of a fee break. But if I go to the next one, you'll see foreign entities, and as you can see, the fees are similar. But as I mentioned, the forms are a lot different. So if let's say I'm an LLC, I'm a foreign entity, I would file an LLC 5, but if I'm a domestic, I'm going to file an LLC 1. So California loves forms, and they have specific forms for every entity type and situation, so you just got to be careful when you're doing that to make sure you're filling out the right forms. If you go to the Secretary of State website, they've got a lot of information out there. It's extremely helpful. So if you need more information, I recommend going there. Okay, so polling question number 1. What does the acronym CDTFA stand for? A, California Department of Tax and Fee Administration, B, California Division of Tax and Fee Administration, or C, California Department of Tax and Fee Admission.
All right, it looks like voting has pretty much stopped, so we're going to go ahead and close this. And 87% of you said the correct answer, which was A. Go ahead, Lauren.
Very nice. All right. Moving on to more fun. Okay, so now that we've registered, how do we close a business in California? So once you've registered, as I mentioned, California had, well, I don't think I mentioned, but California has an $800 minimum franchise tax fee. So once you register, even if you have no activity, if you're doing nothing, California still wants this $800 until you've ceased operations. So I'll go through this list real quick of, how that minimum tax continues and then how we cease operations. So again, if you're registered to do business in California or you're doing business in California, they want that $800. If you're incorporated or organized, if you're active, inactive, so again, you're not doing anything, it still wants that $800. If you're operating at a loss, or even if you filed a short period return. So to cease operations, business entities registered with the California Secretary of State may dissolve, surrender, or cancel when ceasing operations in California and terminating legal existence in California. So a corporation originally incorporated in California may legally dissolve, a foreign corp may legally surrender, and a limited liability company or partnership may legally cancel. Now you may be asking, why do I care about whether it's a dissolve, surrender, cancel? As I mentioned, California loves their forms, and so depending on your entity type and whether you're foreign or domestic, depends on which form you file to cease your operations in the state. Okay, so some steps to continue to close your business. From an income tax perspective, you want to file all your delinquent tax returns and pay any outstanding liabilities, interest, and penalties. California, like most other states, will not let you cease operations or withdraw from the state until you are in good standing. So you want to also file a final return for either the current period or your final year. You want to file your dissolution, surrender, or cancellation paperwork with the Secretary of State within 12 months of the final return. If you do not successfully do this, California will still continue to want that $800. And then last and most importantly, do not transact business in California after the date of the final return. From a sales tax perspective, like income tax, again, you want to file all delinquent returns and pay outstanding liabilities so you reach good standing with the state. You want to file a final return for the current or final year. And you also have to complete and submit a form CDTFA 65 with CDTFA. And then again, do not transact business in California after that date. Okay, so polling question number 2. True or false, in closing a business in California, a corporation originally incorporated in California may legally dissolve?
All right, that is open. And we are at 82% that said true.
Very nice. Okay, so moving on to the fun part of what is doing business in California. There's a lot of gray area here. It's always something we struggle with to advise on, as well as clients struggle to figure out themselves. This slide, I will say, is more of a doing business defined from a franchise tax nexus standpoint, but California says that a taxpayer is doing business in California if the entity or a general partner or member actively engages in any transactions for the purpose of financial or pecuniary gain or profit, or if any of the following apply. Obviously, if you're registered with the California Secretary of State, you are doing business. Sales in California, including those of your agents and independent contractors, exceeds their factor threshold, which, as I mentioned in the next slide, we will actually show you what those factor thresholds are. If you have real intangible personal property that exceeds the factor threshold, you are doing business. If you have compensation, including commissions and payments to independent contractors in California, if that exceeds the factor threshold, you are doing business. And lastly, and always the fun one that we always seem to forget, or always kind of in the back of our minds, is that if either sales, property, or compensation in California makes up 25% of your total everywhere, that can trigger nexus and consider doing business. So, you know, a lot of states, not a lot, but a handful of states have established a, you know, 500,000 in sales, 50,000 payroll, 50,000 property, or this 25% rule. California is very similar. As you'll see on the next slide, they adjust it. But essentially, if I'm an out-of-state company, and let's say I do 400,000 in sales into California, okay, well, so I'm technically under the 500,000-ish, you know, sales rule for threshold, but I only have $1 million in total sales. That's 40%. So I've exceeded the 25% of total everywhere, and therefore you would be doing business in California. Okay, so economic factor presence. There is economic factor presence for income tax and sales tax. I'll start with income tax here. So as I mentioned, they follow suit with similar to other states, but they actually adjust their numbers for inflation. They say they adjust annually, but as we've seen, the last adjustment is as of 1/1/18. So California says if I've got sales that exceed 583,000 or 25% of total sales, I've pierced that threshold. Real intangible property in California is 58,000 or 25% of total, and compensation, including payments to independent contractors, exceed 58,000 or 25% of total. I've pierced that factor presence. Another item that we run into often with a lot of clients who sell tangible personal property is the issue around Public Law 86-272. For those of you who are maybe not familiar with Public Law 86-272, essentially it's a law that protects a state from imposing an income tax on a taxpayer who only sells tangible personal property into a state. It does not apply to services. But basically, as long as I don't have any people or property or anything that would make me taxable in the state, merely just solicitation of sales, then that state cannot impose an income tax on those sales. So let's say, for instance, I'm based in Colorado, just because I sit in Colorado. I sell $1 million into California of tangible personal property. I'm not taxable there. Otherwise, I would source those sales back to Colorado because I'm protected under public law. But, you know, and so I would, again, show no sales apportioned to California, so a zero apportionment factor, zero income tax, but public law does not protect you from the $800 franchise tax. They specifically say that in their rules, and they therefore still require a filing and want you to pay them $800 for the privilege of doing business in their state. So, okay, the sales tax, as we know, before Wayfair, you needed a physical presence in a state to have to file and remit sales tax, and obviously physical presence trumps all, but after April 1st, 2019, with Wayfair, California issued an economic presence threshold for sales tax, and that amount was $500,000 in sales. So this includes sales of tangible personal property delivered into the state by the retailer and also all persons related to the retailer. It also includes exempt sales, so any sales that are non-taxable or sale for resale. And it's important to note that the $500,000 does not include service revenue. Okay. So some other considerations, it seems as though we've seen a lot of companies start investing in other companies, whether it be a C Corp that's got a small ownership percentage in a flow-through entity, or I'm a partnership and I own 30% interest in another flow-through. How does that affect whether I'm doing business in the state of California? And for pass-through entities, you have to consider not only your factors and your activity in the state of California, but you also have to include any factors that would flow through, like your pro rata share that would flow through an investment. So as an example, and I wish I would have just done a slide for this, so I apologize, it's a little confusing, but so let's just say I'm an out-of-state retailer. I've got no property or payroll in California, but I do have $500,000 in sales to California. I'm still under the threshold, technically, under the $583,000, but I've also got this 30% limited partnership interest in company X or B, another company. And let's say, they've got factors in California. They're doing business in California. They've got $30,000 in property. So that's $9,000 in property to me. Still haven't exceeded any of that threshold. They've got $50,000 in payroll, which is about $15,000 to me. Again, still under that threshold. Let's say they've got $300,000 in sales. So that's $90,000 to me. Once I add that $90,000 plus my $500,000, I've exceeded that sales threshold, and now I'm doing business in the state. So now I'm required, California would expect me to register, pay the $800. Another thing to think about is, and this is where California always gets gray and is hard to figure out, is, as I put in here, so another bullet says that an out-of-state taxpayer that has less than the threshold amount for property, payroll, and sales in California may still be considered doing business in California if the taxpayer actively engages in any transaction for the purpose of financial gain or profit in California. This is a hard one to figure out. Again, I think a lot of it comes into play when you have entities that own a lot of interest in investment partnerships. If you've got multi-tiered partnerships, who's considered doing business, who's on the hook for $800. And Jennifer later in our presentation is going to talk about the Swart-Jolly cases, where it's important to note it's not always just about a threshold or exceeding that threshold. It's you could have a small ownership percentage, but maybe you're more actively engaged, or it just depends on the structure and kind of what your role is in that investment as to whether you own the $800. But again, a lot of gray area, but hopefully we can try and give you some hints and open your eyes to some things to think about going forward. But with that, we'll get to polling question number 3. So true or false, an out-of-state taxpayer that has less than the threshold amounts of property, payroll, and sales in California may still be considered doing business in California if the taxpayer actively engages in any transaction for the purpose of financial gain or profit in California.
All right, looks like voting has stopped, and we are at 89% that say true.
Wonderful. All right, well, with that, I think everyone, I'm going to hand the presentation over to Jennifer to talk about apportionment and sourcing.
Hey everyone, happy Friday. My name is Jennifer Barajas. I've been with Eide Bailey going up to close to a year. And as Lauren mentioned, I'm a manager in state and local tax. I spend my time doing a lot of sales tax, and my background, I have a lot of state income tax compliance. So I deal a lot with nexus and notices and audits on really both sides, income tax and sales tax. And California is one of our favorite states because sometimes when you look at the rules, they may borrow ideas from other places, but they always add their own little personal touch. And so, as Lauren mentioned with California, you really have to look at the facts of everything and not just get a 5-minute answer. So let's start with apportionment and sourcing for income tax. The first topic we can talk about is business versus non-business income. When you think about business income, think about what is the business doing, day-to-day activities. What are the assets and activities that generate business on an ongoing basis? So things that kind of happen day-to-day, year-to-year. And there's instances where things happen out of the ordinary course of business and they still may be considered business income. But for the most part, when you think generally about business income, what you're looking at is the regular course of trade or business, tangible, intangible property, whenever the acquisition, management, and disposition of that property constitute integral parts of the taxpayer's regular trade or business. About clear as mud, right? Business income is apportioned. And when you're in California, that means you're apportioning the portion, based on your sales factor of California, and you're giving your other states a piece if you're doing business elsewhere. And the same rule applies if you are an out-of-state company doing business in California. Your business income, which you determine before you get to apportionment, is going to be apportioned for California and for elsewhere generally. A really important case that happened in 2010 and is still being used as reference is the appeal of Imperial Inc. In that case, the Franchise Tax Board ruled that goodwill was an asset that was created, managed, and disposed of by the company in the day-to-day operations of its business, and that more than 50% of the value was attributable to the customer base, trade names, and proprietary software. When most of the time when we think about goodwill, the first thing that comes to my mind is goodwill is an intangible asset, correct? But what really happened in this case is that it set a precedence and other states have followed. There's a similar case out of Oregon that happened before this one. But the facts of this case specifically, the tax court looked at everything the business was doing. And when they had a large gain, they said, wait a minute, you can't set the goodwill piece of this gain and call that non-business income. They basically said that goodwill cannot be divorced from those underlying assets. Since goodwill was created through your day-to-day operations and your customer rapport, and basically goodwill develops with your business as it grows. And so the key factor here is, even though it's an intangible, even though it happened in an extraordinary situation, it wasn't every day, it was a one-time gain, California made this out-of-state taxpayer include that in their apportionable income. So it's really important to look at the facts and circumstances for each taxpayer, even if they're outside of California, and understand what the California rules are and how the state would perceive that gain. Now, switching over to non-business income, which is what you typically would have thought goodwill would be, it's defined as all income other than business income. Examples are dividends, interest, gains on sales when it's a passive investment, meaning if you are in the business of, say, selling lawnmowers and you have some ownership interest in some partnerships of, say, an accounting firm. Well, you're not really doing anything with the accounting firm business. You just gave them a little bit of money to get going and you get some K1 income. Your facts and circumstances might be, hey, you're in the lawnmower business and you're just getting a little piece of income from this other business. They're going to treat their business income as business income, so your piece is considered non-business. You kind of have to look at the whole big picture of what's going on in your company, and you can have passive investments and those would be treated as non-business, in which case you want to allocate those to the state they have situs in. But before you jump to the conclusion and decide where to put things in which bucket, you really do need to kind of take some time, look at the California rules, and then look at the facts and circumstances on what happened before the income happened. Business income and non-business income is an important piece, but once you've got your income in each bucket, then you have to know what to do with it, right? So the next step here would be apportionment for California and sourcing, which is assigning sales to California. So we talk about income tax. Generally, most taxpayers apportion business income. Intangibles, so let's get into the sales factor piece of your apportionment. Payroll and property are a little bit more clear. It's usually if property is in the state, it's in the state. It's not in the state, it's in the other state kind of thing. Same thing with payroll. It's usually based on the employee's location, or 1099 if you have contractors. But when we get to sales factor, intangibles are considered to be California sales if they're used in California. Services are sourced to California to the extent that the purchaser receives the benefit in California. And what that typically means is you are a service provider, but your customer is in California. California takes the position that they're located in the state, you know, they're using your service in the state, even if you're providing it over the phone to them in another state. California takes the position that if your customers are here in California, they're receiving the benefit of your service in the state. So you then need to assign those sales where the California customers are located. Sale, lease, rental, or licensing of real or tangible property is sourced to California if the property is located in California. So when you think about market-based sourcing, you essentially just need to ask, where are the customers located? If you are able to figure out where they're located, and you should, you know, advise all of your clients to have the ability to locate the customer to the best they can, whether it's delivery address, billing address, etc. Now, a hot topic right now with market-based sourcing in California is that there are proposed amendments to the market-based sourcing rules. They haven't passed yet, and there's I think it's COST, which is a big state tax nonprofit that is appealing to the FTB, essentially saying, please don't pass these amendments because this is what they're trying to do in California. As of right now, they have a set of rules for how to source sales if your customer is an individual, and they have a separate set of rules for how to source and assign sales if you have business customers. And that's how it exists as is. The proposed amendments want to eliminate the two different rule sets and have one set of rules for individual customers and business customers. And for existing organizations doing business in California, they're going to have to redo how they're tracking sales, and that is going to be a mess. It's going to create issues with audits for companies that typically rely on billing address of individuals. That was considered acceptable. And if the amendments pass, you can no longer use billing address for individual customers. You'll have to find out where the customer actually is. And with doing so much business on the internet these days, that's not always very clear. For example, if you are selling an app on an app store and you get a monthly subscription, you know, let's say that it's mostly individuals buying your app. Are you supposed to track their phone all around the state or wherever they're traveling to figure out where they're using your service? It seems a little bit ridiculous when you think about it. If you have an app on the App Store and say Apple or Google, whichever store it is billing these customers for you monthly as a convenience, then billing address should be appropriate to use, correct? I mean, that's easy to find, it's easy to track it. This concept of trying to figure out where customers are using your product or service, if it's something like in the cloud like that, it's going to be it's just really, really, really detailed and granular, and it's going to create a compliance burden for a lot of companies. So something to follow. If those amendments actually pass, I anticipate that we would probably write an insight on our firm website about it and have some more information there. So we'll just have to kind of wait and see what happens. Destination-based sourcing is a little bit easier to understand. If you're selling tangible personal property into the state, it's just simply where was it delivered. If you're selling t-shirts, if you're selling pencils, or something that you can actually hold in your hand, how did you get it to the customer? They either came to your store to pick it up, or you delivered it to them in the state, and then in that case you use delivery address. We have PL 86272 on here. I'm not going to talk a whole lot about that, other than California follows that guidance very generally, but most businesses these days have evolved to sell more than just products. Even product-based businesses are starting to offer training for their customers. They're selling products plus add-on of services. So there are still companies out there that are very product-based businesses. And if you are strictly in a product-based business and you only go into a state to solicit for sales, and then you get back out of the state, process orders elsewhere, and are not frequently going to the state, you're not delivering products in your truck, then it is likely you would have some protection under PL 86272. We don't typically rely on that. We don't like to just assume a product-based business does have that protection, because it's very narrow. It could be a big win for you if you do fall into that narrow, group of activities in the state. Then you don't need to pay tax where you're not required, and that would be great. We just simply don't like to jump to that conclusion that businesses fit that narrative. So always take a second look a little deeper, find out exactly what employees and contractors are doing in the state to see if that protection applies or not. Switching gears to sales tax. It's a little more simple if you're inside California, and it's a little more complex if you're outside. But I want to give California props for one thing with sales tax, and that is that they do not tax yet software as a service. So if you are in a service business in California or outside of California, or if you are in the software as a service business, you may have nexus in California, but you probably don't have a lot of risk associated with not registering and collecting. So that's one little bone that California has thrown out to people, is as now they're not taxing software as a service. If you are a California retailer and you are inside California shipping to California customers, you get to use origination-based sourcing up to your first $500,000 in sales. And what that means is, if you're in Los Angeles and you're selling, t-shirts, whatever it is that you're movies, whatever it is your business is, if you're selling from Los Angeles to the rest of the state, the first 500,000 of sales, you get to say are Los Angeles-based sales, because that's where you're located, that's where the shipment went from, and it's just more for the convenience of small businesses in California. So you tax the customers based on your physical address. You use the California sales tax rate, and then the local county, special districts, and cities you get to use based on your physical address. Once you exceed that $500,000 threshold of sales, if you're inside in California, then you have to start doing destination sales, meaning you're the LA t-shirt shop, business is booming, you sell 510,000. Well, that 10,000 above 500, you need to make sure you're using the customer's delivery address to charge them tax. So it'd still be, California state, but it might be a different county, different districts, different city tax. And so California-based businesses can operate as origination. And then once your business grows beyond 500,000 in a year, you need to make sure that you've got a system in place to collect the correct rates. Otherwise, it can be kind of messy. Now, if you are located outside of California, and Lauren had the economic threshold test for sales tax, if you're located outside of California and you exceed that 500,000 sales, then you need to register and start collecting sales tax in California. But you may ask, well, how? I'm not there. I'm not located in California. So what rates do I use? Well, if you're outside of California selling into the state, then you have to use the customer's delivery address to get those rates. California state, the county they're in, the district they're in, and the city they're in, if any. And you've got to be able to look up those rates for each different customer. You don't get to use just one. So it's a little bit more of a burden, but at least they're giving you that, well, you don't have to do this until you exceed 500,000. At that point, give us a call. Switching gears over to pass-through entities. Lauren touched on these a little bit earlier. California taxes, pass-throughs, sort of in a hybrid model. S-corps are taxed both as a pass-through and a corp. LLCs are pass-throughs, but they have an entity level tax. And then true partnerships typically don't have an entity level tax, but they do have withholding requirements if they have any non-resident members or owners. Here is a summary of the forms to file. So if you're just getting set up in California, or you find out that your investments are sending you California K-1s and you feel that you've started doing business in the state, this is what you need to know. If you notice in the far right column, we have subject to $800 annual tax. Every single one of these entities is subject to it. So even if you're a single member LLC and you don't pay any federal tax, you don't file any federal tax, California wants they want your information. Being a single member LLC doesn't mean much in California. They still, if you're doing business in the state or if you're receiving income from investments doing business in the state, they want you to file a return. So where this gets a little messy is if there's multiple tiers of ownership, like you could have 10 single member LLCs. And the big question is, should each one pay the $800 tax? And the short answer is yes. Is there an argument out of it? Maybe. But the short answer is that is where California is making their money, is they're wanting each entity in that chain to pay the $800 or more, depending on how it's calculated. So if you are a pass-through doing business in California, either located there or outside of the state, but doing business in California, then you have to withhold tax if you have non-resident owners. If there's a real estate sale, you've got to withhold tax. Estate and trust distributions that are California-based. Non-compete covenants, rents, leases, and royalties on property. Partnership and LLC distributions over $1,500 in a calendar year. Installment sale gains of tangible personal property if the property is located in California. And gambling winnings. So while most pass-throughs don't have much to pay besides the $800 minimum or a percentage on the income for LLCs and S corps, this is where pass-throughs have compliance burdens. They have to do the withholding tax. There are some instances when you do not have to withhold, and here's a little bit more detail about that. If you're, so for example, in the real estate sale, if you're paying an LLC, a partnership, or a corporation, and they're registered with the Secretary of State, they have a permanent place of business in California, then you don't need to withhold. But California still wants you to get the valid form in place. And then going back to the partnership example, if your partners or members are individuals, but they live in California, you don't have to withhold when they live in California and are considered a California resident. Again, you need to make sure you get the forms and keep those on file in case the state ever asks you for them. This is what that form looks like. So if none of the boxes apply to you, it's not the form for you. I think you only need to fill this out once and keep it on file. It's not something that has to be done annually. So back to our real estate sale, or if you're a partnership that has these types of partners, C Corps, LLCs, another partnership, if they are not registered with the Secretary of State, they do not have a permanent place of business, and they did not give you the Form 590, you've got to withhold. And that burden is on the pass-through, so on the entity that's doing business in California. And the penalties are pretty nasty. So here's a little bit more information about that. Same thing, if you have an individual partner or member and they're not a resident of California, California wants you to withhold on this individual because it assumes if you don't withhold on them, California thinks they're never going to see their money. this is the summary of withholding that you provide annually. It's got the information that the C Corps, LLCs, individuals, whoever it is that you are required to withhold on, this is the information they need when they file their returns to show that they've gotten a payment of tax paid on their behalf, and they can get credit for it. Other withholding options. If you pay a corporation, an LLC, a partnership, or an individual, and they fill out the non-resident withholding waiver request, you don't have to withhold. But you have to wait until you receive a waiver approval letter. So if you start trying to get signatures on these forms 4/15 or 4/13, and you've got to make the payment by 4/15, California wants you to still make the payment until you get the approval letter from them. So it's, of course, California wants you to jump through extra hoops before you're allowed to be out of that withholding obligation. Another option is similar if you have a corporation, LLC, partnership, or individual, and they submit the 589 electronically and also send you a letter, then you can withhold a lesser amount, but California is going to tell you how much. So more hoops to jump through for compliance. Okay, let's talk a little bit about some of the cases specific to pass-throughs that have been hot topics in the news. Probably the most famous one is the Swart case. And what happened in that case is that a taxpayer filed returns, paid tax. They were receiving K1 California information from a California-based LLC. Swart only had a 0.2% ownership in the LLC, and it was not owner managed, it was manager managed. So the reason that Swart prevailed, and they filed amended returns and requested a refund, the reason that the court sided with the taxpayer is that they felt the ownership percentage was so small, the fact that it was a minority interest, the fact that someone else was managing the day-to-day operations of the LLC, they basically had no management control, no decision-making power. It was truly passive. The court considered it to be acting within a limited partnership role, a limited partner role. Even though this was an LLC situation, the conclusion they came to was that this was a very limited role of an owner. And so the taxpayer prevailed. Now, what happened since then is that immediately after the case, the FTB came out and said, the department intends to follow this decision based on a bright line test of 0.2%. The FTB said, okay, for any taxpayers out there where you have this limited ownership interest of 0.2 or less, 0.2% ownership interest or less, you're not considered doing business in the state. And then in a subsequent case, Jolly, the taxpayer prevailed in this one as well. And what the Office of Tax Appeals found in that case is that this bright line test of 0.2% ownership is not enough to determine what's really going on. The Office of Tax Appeals is essentially saying you cannot set a bright line test of ownership at 0.2%. An owner may have a slightly bigger ownership interest, and in Jolly, I think it was 4.65% ownership, and the facts were similar. It was a member managed California LLC. Jolly did not have the right to act or bind the California LLC in transactions. They had no management control. And so essentially the Office of Tax Appeals sided with this taxpayer saying, even though you exceeded that 0.2% threshold that the FTB is claiming happened with Swart, you're still not considered doing business in California because the facts are very similar and you are essentially acting as a limited partner. Again, it was another LLC, but the way that the court took the case was looking at the big picture of what is this member actually doing in terms of running the day-to-day business, what kind of control do they have over management operations, and they found that they did not have any of those controls. So they felt like we're siding with the taxpayer here. They have very limited to no involvement. They own a very small ownership percentage. I think theirs was 4.65%. And so this taxpayer was considered not doing business in California. So the key takeaway from there, from all of these cases, is that you really have to look at the facts of the owner slash member slash partner and their involvement with the California-based company that they're, receiving investment income from. How involved are they? Are they a general partner? Are they a limited partner? Are they, do they fly down for meetings? Do they vote on different types of decisions? Or is the LLC or partnership, do they have a hired board of people or hired type of manager to handle all of that stuff? Ownership percentage does matter, but what the court essentially said with Jolly is that you cannot only look at ownership percentage. So that's the key takeaway here is, does every business that receives California income need to pay the $800? Maybe not. The conservative answer is you might be doing business and you probably should pay it. Are you able to craft an argument that you're not doing business? You might. So don't read either one of these cases and assume that you can just have a blanket application to your client or for a taxpayer. Although it's still exciting to see taxpayers win against California when it comes to this, I have to admit. Time for polling question number 4. True or false? Income is derived from transactions and activity in the regular course of a taxpayer's trade or business and includes income from tangible and intangible property, the acquisition, management, and disposition of which constitute integral parts of the taxpayer's business.
All right, looks like polling has slowed down. So we have 35 people that say 100%. So good job.
I think that Lauren and I covered pretty much everything we were looking to cover today, and we wanted to leave a few minutes for questions. Have we had any come in through the Q&A, Amy, that we've not answered yet?
No, but if anyone does have a question, please feel free to use the Q&A box, or you can use the chat feature. Maybe you answered this one, but providing software services is not taxed in California. Is that correct?
Correct, for sales tax purposes. About 21 states do tax it, and California being an aggressive state, you would assume they would get on board and tax it too. But as of right now, software as a service is exempt from sales tax in California. People are usually surprised to find that out.
All right. What California localities, cities, or counties currently have gross receipt tax?
I can think of San Francisco having a gross receipt tax. Lauren, do you have any others you can think of?
No, I mean, that's the one that is most common and I think we see all the time. I'm sure there are others and we could do more digging. Just off the top of my head, I can't think of any at the moment.
Perfect. Well, oh, here we go. For sales tax, what is the likelihood of state audit? Also, are there filing intuitives? If that made sense.
What is the likelihood of an audit? Well, it depends on if a client is currently filing there. What we've seen happen a lot recently is clients kind of hearing about Wayfair that are, that have no physical presence in California. Those type of clients are not likely to get audited, right now necessarily, but since the case happened in 2018, most people are trying to become compliant from end of 2018 on. So there's BDA options, voluntary disclosure, for out-of-state taxpayers that have been selling into California for a long time. And what we typically do is request a limited look-back period for that. Instead of the traditional time frame, we look at when did economic nexus for sales tax happen, and can we reduce the look-back period to just when economic nexus was enacted and when the taxpayer actually exceeded it. We have a lot of clients that have been filing in California for a long time and get state audit notices pretty regularly. I have one that I just closed for a client, and they literally opened a second audit for a different period before the first one even closed. So if you're on the radar, it is a state that does do a lot of auditing for sales tax.
Perfect.
And the filings, the sales tax filings, they're not necessarily complicated, and you do it online through their portal, but it is cumbersome. You report all the different levels of tax and your sales, and they all have to reconcile, and it does take some time, but it gets easier every time you do it.
All right. Well, those are all the questions that have come through. So we will go ahead and say thank you all so much for attending, and thank you to our presenters. We hope that everyone has a great day.
Thanks, everyone.